Welcome to the Deep Dive. Today, we're opening a really fascinating window into a key moment in modern finance. We're looking at the 2005-2006 leadership transition at JPMorgan Chase.
Right. And what's great is our sources aren't, analyst reports. They're the actual shareholder letters from the outgoing chairman, William Harrison, and the incoming CEO, Jamie Dimon.
Exactly. So you get this rare side-by-side view.
Yeah. And our mission really is to unpack these two, pretty distinct management philosophies. You've got the legacy view focused on consolidation, scale, versus the new approach, which was all about relentless execution.
And we want to distill what that means, sort of a blueprint for navigating the global finance world back then.
For you listening, it's like a masterclass in how a leader steps into a huge company and just immediately sets a new bar for success.
So we'll unpack the core beliefs, size, ethics, diversification, but also the, let's be honest, sometimes pretty brutal assessments and the concrete plans Dimon laid out. Let's dive in.
Yeah.
Okay, section 1, Harrison's legacy. To really get it, you have to appreciate his journey. 38 years.
Yeah, starting way back in '67 at Chemical Bank.
And the story that got me was he apparently took the job planning to go back to North Carolina in like 2 years.
Yeah, right. And ends up staying almost 4 decades leading this global behemoth.
It's quite something.
It really frames his perspective, doesn't it?
Absolutely. That long tenure meant his beliefs were rooted in a very long-term cyclical view, not the day-to-day market noise. He stepped down feeling the bank was well-positioned because he'd built it to last.
And he had these core ideas. The most famous one, probably, his take on scale. He said, quote, "Size does matter in our industry."
But crucially, he added a big if.
Right.
Size only matters if it actually translates into real operating efficiencies, stronger earnings, and, genuine leadership positions.
Otherwise, it's just bloat.
Exactly. Bigness for bigness' sake. Worthless. He knew that.
And he linked that to needing a performance culture, teamwork, partnership.
And resisting that, what he called the quarter-to-quarter mindset, that was huge for him. Manage for the long haul. Good advice.
Timeless advice, really. And that other classic principle, surround yourself with people smarter and better than you are, which actually sets the stage perfectly for Dimon.
Okay, so section 2. Dimon steps in. The new mandate.
Right.
He's respectful of Harrison's foundation, you can feel that, but the tone is definitely different. Urgent. He mentioned feeling a tremendous mix of emotions, excitement, and a great sense of obligation.
Yeah, if Harrison drew the map, Dimon arrived with, the compass and the drill sergeant. His immediate focus wasn't grand strategy adjustments, it was execution. And principles, foundational stuff.
What were those principles?
3 core things. First, share the truth. Honest assessments, no sugarcoating. Internally, externally, everywhere.
Okay.
Second, integrity and honor. Always do the right thing, not necessarily the easy or expedient thing. That's a direct quote.
Putting ethics right up front like that, especially in finance, sends a powerful message.
It absolutely does. It says, we'll be judged not just by profit, but how we make it.
Makes sense. And the third?
Relentless focus on execution. Putting those principles into action. Dimon's message was clear. We have the strategy. Now it's about discipline, hard work, delivering on the potential, raising the bar.
All right, section 3, strategy. Do all these different businesses actually belong together?
The big question, right? Dimon tackled it head on. Are we in the right businesses?
And his answer was?
A very firm yes, based on sort of 3 pillars. Strong market positioning, the value you get from linkages between businesses, and just the raw competitive strength of scale.
Okay, let's talk about those businesses. 6 main lines.
Yep. Investment banking, commercial banking, retail financial services, card services, asset and wealth management, and treasury and security services. Big players in consolidating industries.
Now, this idea of linkages, Dimon made a really interesting point about language. He said cross-sell is misleading.
Yes, he hated that term, said it implied something forced and unnatural.
So what was his alternative?
Natural product line extensions. It's a subtle shift, but strategically, it's huge.
Why? What's the difference?
Well, cross-sell sounds like something the bank wants to push on you for its benefit. Natural product line extension means offering something because you, the customer, probably need it anyway, and you already trust the bank.
Like his Walmart analogy, they sell lettuce and tomatoes because it makes sense for the shopper.
Exactly. It's customer-centric, not bank-centric.
And the numbers seem to back it up.
They did. Look at retail and card services. By leveraging existing branch relationships, credit card sales in the branches jumped nearly 100% in 2 years.
Wow.
Or investment banking and commercial banking. You had commercial bankers in places like Austin or Denver, no big IB office there, but they were generating hundreds of millions in investment banking fees just by tapping into the trust they had already built locally.
So the value flowed naturally.
Precisely.
So scale gives you diversification capital, risk, earnings, and that lower cost of capital, which is huge in banking.
Massive advantage. But Damon immediately added the warning.
Which was,
Scale is dangerous if you don't manage it. Bureaucracy and waste are lethal. You have to stay lean and integrated.
okay, section 4 then. The push for outstanding performance. Getting lean.
And this is where Dimon was really blunt. He stated flat out, performance was not yet outstanding. Costs too high, returns too low.
No pulling punches there.
None. This required, quote, consistent effort, focus, hard work, and discipline. It was overhaul time.
And the scale of this overhaul, it sounds massive. They'd already saved $1.9 billion from mergers.
But he said much more is needed. They launched these huge systems conversion projects, standardizing everything.
Can you give an example?
Well, the credit card conversion. They called it the largest in history. Merging over 30 million accounts onto one single platform.
Imagine the logistics of that.
Herculean, really. And doing it without major disruptions. Then they integrated all U.S. dollar clearing onto one global platform, processing, what, $3.2 trillion a day?
Staggering numbers. That's where scale becomes efficiency.
If you manage it right, yes. And they were building for the future, too, not just fixing the present.
The Global Services Center in India.
Right. 2 phases completed in Bangalore, hiring thousands, 8,700 employees mentioned, building that sustainable, efficient global infrastructure.
So it wasn't just about cutting costs, it was about building capacity.
And managing capital actively. They sold off non-core stuff, manufactured housing, the insurance unit freeing up billions.
Billions in capital, where did that go? Not
Yeah.
just cost cutting, right? There were growth investments.
Absolutely. Targeted growth. They bought collegiate funding services. They invested in innovation like that Blink credit card technology they were piloting.
Oh yeah, the tap-to-pay precursor.
Exactly. The goal wasn't just cuts. It was profitable, sustainable, organic growth fueled by efficiency and innovation.
All right, let's shift gears. Section 5. Managing risk. Always the elephant in the room for a bank this size.
Critical. As the letter said, almost all of our businesses are risk-taking businesses. You can't avoid it. You have to manage it obsessively.
They listed 5 key areas, right? Credit risk, market risk.
Yep. Consumer and wholesale credit, market trading risk, interest rate liquidity risk, reputation legal, and operational catastrophic risk. Covering the bases.
But the really interesting part was their focus on preparing for the inevitable downturn, the cycle.
Yes, they knew a recession would come eventually. They were modeling it internally.
How bad did they think it could get?
Their estimate. In a recession, credit costs could spike by more than $5 billion.
Wow. Okay, that's a big number to plan for.
It really is. And it tells you the scale of loss they needed to be able to absorb without, collapsing. So preparation had to be intense.
How did they prepare for that kind of hit? What were the defenses?
2 main things. First, stronger, more consistent profits across all those diversified businesses, a cushion. Second, maintaining what they explicitly called a fortress balance sheet.
Which means, can you break down Fortress balance sheet for us? What's Tier 1 capital?
Sure. Tier 1 capital is basically a bank's core equity, its main cushion against losses. Think of it as the shock absorber. They reported theirs at 8.5%. Calling it a fortress meant they were deliberately keeping way more capital than regulators required just to be safe.
So even if that $5 billion loss hit, they'd still be standing strong.
That was the plan. Build resilience.
And you saw that risk aversion in their lending too, right? They mentioned avoiding certain products.
Definitely. Limiting exposure to low prime and subprime credit. And specifically calling out not doing high-risk stuff like negatively amortizing optionariums.
Those are the ones where your loan balance could actually go up even if you made payments.
Exactly. A ticking time bomb. Avoiding those, even when competitors were chasing volume, that shows that do the right thing, principle in action. It was about sustainable risk management.
Okay, one more risk point. Legal risk. They admitted something pretty stark there.
Yeah, that despite all their efforts, high legal costs were likely to be a higher permanent cost of doing business for the foreseeable future.
A permanent cost. That's
Yeah.
quite an admission.
It is. It basically says, look, the world is complex, regulations are tough, litigation happens. We have to bake significant ongoing legal expense into our core operating model. It's not just an occasional problem, it's part of the landscape.
Okay, final section. Section 6. People, culture, compensation. It all comes back to the team.
Absolutely. The letter stresses building a great team, a meritocracy, not relying on a few star athletes, as they put it.
And the pay structure had to reflect that.
Had to. The philosophy was pay for performance, real performance measured against the best out there, not just against last year or the average competitor, absolute target.
And they made some symbolic moves too, didn't they? Cutting perks.
Yeah, that was part of shifting the culture. No more club memberships for execs, reduced severance, no 401k match for the highest earners.
But they also said they plan to pay people more overall. How does that work?
It's about reallocating. Strip away the little entitlements, the symbols of hierarchy, and focus the money on performance-based pay and broad ownership. Signal that value comes from contribution, not status.
And ownership was key.
Huge. Over 120,000 employees own shares or had options. That's about 14% of the company owned by the workforce. That aligns interests.
They also touched on corporate citizenship. $100 million plus annually. The Hurricane Katrina response stood out.
It really did. Guaranteeing jobs for affected employees, providing relief, even letting competitors use their working branches. That kind of action in a crisis, well, it says a lot about the culture they were trying to build. It wasn't just talk in a letter. It was, tangible action, like their environmental policies, too.
Okay, let's wrap this up. Synthesize the takeaways from this deep dive.
Well, when you put Harrison's long view and Diamond's execution focus together, you really see a formula emerge for maximizing value in these huge, complex companies. It's this constant loop, aggressive operational efficiency, laser focus on executing the plan, rigorous preparation for the inevitable downturns in the cycle, and underpinning it all, those high ethical standards.
And for you listening, maybe you're running a totally different kind of business.
Yeah.
That shift in language around cross-sell is powerful. Moving from pushing products to offering natural product line extensions, it's a reminder that scale only works if it genuinely gives the customer more for less. You have to earn that growth.
Yeah, absolutely. Which leads to maybe one final thought to chew on. Diamond was obsessed with being lean, ruthlessly efficient, right? Squeezing waste out of processing trillions daily. Yet in the same breath, he basically accepts that massive legal and compliance costs are now a permanent, unavoidable feature. So how does a company square that? The drive to be hyper-efficient everywhere while accepting this huge, seemingly irreducible cost center, what does that tension tell us about just how complex and, frankly, risky the whole global finance game had become and maybe still is?
A great question to leave us with, something to definitely think about.